$10,000 that you shift to the K1, you're saving $1,500, and we're able to save her $126,000 in taxes a month. If you're submitting a tax return where your income statement is all beautiful, nice, round numbers, that is a huge IRS red flag and can trigger an audit. Law is there for us to use to our advantage.
Is there a strategy that you've used that made even you go like, wow, I cannot believe that this is legal? Most contractors I meet are incredible at what they do. They're building homes, laying concrete, wiring systems, but when it comes to money, sometimes it's, a minefield. Today, I'm sitting down with a CPA and a tax strategist, someone who's helped hundreds of construction companies not just stay out of trouble, but actually build wealth. And what he reveals might just blow your mind today, so stay tuned. Edward, welcome. I'm so excited to have you today.
Yeah, thank you so much. Great to be here.
Yeah, can you tell us a little bit about what you do and how you came to it?
Yeah, sure. It was a long journey, but let's get to the what I do, and that's the part I love the most, which is we help business owners keep their hard-earned money and not give it away to Uncle Sam, and at the same time grow their wealth. And that is everything in a nutshell, and we're going to get into more of it on this interview.
I know. I'm excited to chat because a lot of times, on my side as an accountant, bookkeeping, we focus on people making more and more money, right? That is what I am excited about. But then after they made all that money, they don't really want to give it all away. So the government created a lot of incentives for us to follow to be able to keep some of it. So I am excited to chat about that. So let's start with my favorite question. I would say the question that I have. What is the most costly mistake that you have seen a contractor make with their finances?
Yeah, that's a great question. I wanted to kind of follow up with that idea that you mentioned. As a business grows, they have so much more money that comes in on the bottom line. And I always say it's not always how much you make, but it's how much you keep. Because the more you start making, the higher that percentage, meaning the tax bracket is that you're exposed to, that you ultimately have to cut that check to Uncle Sam. And we don't want that to happen. So, kind of on that point, the biggest mistake that I see contractors make is not tracking expenses properly, right? There are some business owners out there that use personal cards or personal, accounts to pay for business-related goods. And sometimes even if they do use the business, their accounting on the back end is completely incorrect. So there's no kind of job costing. Things could go into distribution that are actual expenses for accounting purposes. And you find that just based on that, you're going to end up overpaying if you're not tracking things correctly.
Mm-hmm. Yeah, especially with the construction industry, when you have to know your numbers by project, you have to separate your finances. It is a risk if you don't do it right. Well, here's a fun question. Is there a strategy that you've used that made even you go like, wow, I cannot believe that this is legal?
Yeah, so there's several. There's several that I'm still kind of amazed with as far as, this is actually allowed in the tax code. The one that I kind of want to emphasize here and bring up is the short-term rental loophole that we love to kind of incorporate as much as we can. And it's essentially allowing an owner of a short-term rental property, which is 7 days or less, to be able to categorize that activity as ordinary income, where normally rentals are passive income. And by categorizing it as ordinary income, any losses are actually used to offset your ordinary income. The biggest one, we stack that with the cost segregation study, which is essentially an accelerated depreciation strategy, which allows you to accelerate the asset itself, which is the building or the apartment that you're renting, and take a gigantic deduction in year one. And that basically could sometimes wipe out your income altogether where you pay zero tax. Another one that I really want to talk about, which I think is amazing and why the rich stay rich, it's the step up in basis upon death. If mom and dad die and the property goes over to you, any assets that they have get a step up in basis where you essentially can sell it the next day and pay zero tax on it. So an example would be they bought an apartment 20 years ago for $300,000. Fast forward 20 years, they pass away. That apartment is worth $2 million. They pass away, it passes over to you. You can turn around and sell it tomorrow for that $2 million and pay zero tax because you get a step up in basis for that transaction.
Yeah. Okay. And the good part about it is it doesn't matter if you're in construction or any other industry, you can use those strategies to offset any sort of, income or, keep the money safe. That is interesting. Okay. So let's say if somebody would have handed you their books right now, what are some of the red flags that you would be looking for?
Yeah, great question too. So if I'm looking at a new set of books, which is what we do for all the new clients that we pick up, we take a look to see what's going on, both in the income statement and on the balance sheet. We want to make sure that the income statement does not have beautiful round numbers, because that for sure is going to be a red flag. We want to make sure things are categorized correctly as far as gross income, cost of goods sold, and administrative and general expenses on the bottom. We want to make sure those things are categorized correctly and there are detailed categories for everything. On the balance sheet, we want to make sure that the proper credits and debits, meaning the positives and negatives, are in the appropriate categories. Meaning we don't want to see negative bank account balances. There could be situations where they're overdrawn, but a lot of the time, if there is a negative account balance on a bank statement, it's probably an accounting error, right? We want to make sure that liabilities aren't in the asset section and, vice versa, as far as assets are in the liability section. And we want a nice set of books. If it's wrong and it looks weird, then we know that that tax return may be incorrect. They probably overpaid or underpaid taxes. And now we have to start kind of, digesting this deeper and making sure that everything is correct.
Makes sense. We get a lot of different clients that are coming in with very, very messy books. And when you see a negative $100,000 account on the checking account and a bunch of payables, receivables, and the loans that are all negative, that is a lot of negative red flags right there. And the balance sheet, I feel like, is usually the most messy part of the books because profit and loss is a little bit easier to understand to where you want to categorize things. But as soon as it comes to assets and liabilities and equity, people get a little bit stuck on those.
Yeah, the P&L resets every year, right? The balance sheet is forever. So the biggest thing there is you got to make sure that you clean these accounts up on a regular basis. One more thing that we didn't talk about, sales tax accounts. You got to make sure that those liabilities are paid out. We've seen a book of a set of books recently. We just picked up a new client, and their sales tax account hasn't been zeroed out in years, and it just keeps accumulating. Like, where are you booking the sales tax payable? So it could be a mess. It could be a mess.
All right. Tell me this: what is one thing that you wish that every business owner knew about taxes, but they don't even ever ask?
Aside from how taxes work at baseline, because that would probably be the biggest thing that I want to be asked, to understand how taxes work, how payroll works, right? How do you take money out of the business properly? Because I'm sure you see this day in, day out. Some business owners just treat their businesses as a personal piggy bank. And that's not exactly ideal. But as far as, actual tax strategy, I wish we got more the question of, how do we strategically pay less in taxes strategically. And what I mean by that is, as a business owner, a lot of the things that you're already doing, even on the personal side, could be pushed in and categorized as a business expense if you structure things the right way. And I talk about this a lot on my channels, right? We're talking about, setting up board of advisors, hiring family members, things that you're doing anyway, even with like friends, family, etc. If you're structuring it the right way, you can pull these expenses in as business deductions. And a lot of the stuff is usually left on the table. We don't want to pay more tax than we have to.
That is the goal, not to pay, more than we have to. Now, coming back to the construction industry, what is the strategy that you can advise that only you feel like maybe 5% of contractors use and every contractor actually could benefit from it?
From a tax saving strategy, only 5% of contractors use. This is a commonly omitted strategy in general, and that's setting up a board of advisors or directors for your business. And it doesn't necessarily have to be a full board, right? Even you as an individual running a business have to have some kind of, minute meetings during the year. If it's not once a year, at least could be quarterly. You still sit down as a business owner and go over everything that happened. Let's say you do it once a year. What happened last year? What's going to happen in the next year? You can review year-over-year performance. I like to suggest doing it at least once a quarter. You can even do it once a month. What tax benefit, can we pull from here? Well, if you're having a meeting, it has to happen somewhere. It can happen at a restaurant. It can happen in your home. It can happen, overseas. If you add board of advisors to this business that you're running, now you have a group of individuals that you trust that either work in the business or advise you in the business that you can bounce ideas off of and go over on a quarterly basis, performance, people that have been fired, people that have been hired, what jobs you picked up, what jobs you want to stay away from, moving to a new location. You can discuss all of this at the meeting. And at the same time, you can deduct wherever you are. So this could be at a conference room in a hotel, or it can be in a restaurant, or it can be in your own house, and then figure out a way where your business pays your home for the space that you're using. So a lot of creative stuff that a lot of people just don't take advantage of.
Yeah, sometimes you would hear those strategies and they would seem like out of reach, right? A little bit more complicated than we can wrap our mind around. So for me, for example, I remember the first time I heard about Augusta rule, which is kind of what you're referring to a little bit, I think, in the way of using your home for this strategy. And I still haven't used that strategy. You know why? Because I am nervous about it. It feels like it might create more problems for me in the long run with the IRS, or maybe hard to implement compared to the reward that I will receive from it, right? Mm-hmm. So for people who are like, oh my gosh, this sounds complicated, I'll probably get in trouble, what would you say?
Well, first of all, I say you and I have to talk after this. Okay, that's first and foremost, because we'll get into this conversation on a personal note. But to all the viewers out there that are watching this, some of the things that are presented may sound a little aggressive, right? But we have to make sure that when we are implementing something, we're doing it based on the nature of what the IRS intended. For me, the IRS, the Internal Revenue Code itself, the IRS, law is there for us to use to our advantage, right? This is what it's been created to do. It's there for our advantage. We have to utilize it to the fullest. And as long as we do it based on the law and not kind of exaggerate, which some people do, then you're going to be okay. And what do I mean by within the confines of the law? You have to have a proper entity structure. You have to have the board meeting or the minute meeting. It has to be substantiated. things actually have to get done. We got to dot all the I's, cross all the T's. And that way, if you, like, let's go back to you real quick. Happy to have that conversation off camera, but let's go back to you. You're running you're